The silver to gold ratio just hit 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. This has only happened 3 times in modern history: 1991, 2008, and 2020 during the COVID crash. Every single time, the ratio collapsed violently afterward. Silver exploded higher against gold. The people who bought silver at extreme ratios made fortunes. And we just hit that extreme again. Here's why this matters and what always happens next. What the ratio actually measures. The silver to gold ratio tells you how many ounces of silver equal 1 ounce of gold in price. If gold is $2,500 and silver is $30, the ratio is 83 to 1. Historically, the ratio averages between 50 to 1 and 70 to 1. When it goes above 80, silver is extremely undervalued relative to gold. When it drops below 40, silver is overvalued. The ratio isn't about absolute prices, it's about relative value. And right now, silver is as cheap relative to gold as it's been in decades. The historical pattern? Every time the ratio exceeded 80 to 1, it snapped back violently, not gradually, explosively. In 1991, the ratio hit 82 to 1. Over the next 2 years, it collapsed to 40 to 1. Silver doubled against gold. In 2008, the ratio spiked to 83 to 1 during the financial crisis. Within 3 years, it crashed to 31 to 1. Silver tripled against gold. In 2020, the ratio hit 120 to 1, briefly, during the COVID panic. Within 1 year, it collapsed to 60 to 1. Silver doubled against gold. The pattern is consistent. Extreme ratios don't last. They reverse violently, and silver always catches up explosively. Why the ratio gets extreme? High ratios happen during flight to safety events. When investors panic, they buy gold as the ultimate safe haven. Silver gets sold because it's seen as more industrial and less monetary. Gold rallies hard, silver lags or falls, the ratio spikes, but this creates a massive mispricing that can't be sustained. Because silver isn't just industrial, it's monetary. And when the panic subsides, investors realize silver is extraordinarily cheap relative to gold. The industrial demand difference. Here's what makes this ratio extreme different from past extremes. Industrial silver demand is at all-time highs and growing. Solar panels, electric vehicles, electronics, medical devices, all consuming silver at record rates. Industrial demand is structural and inelastic. In 1991 and 2008, industrial demand was moderate. Now it's exploding. That creates a floor under silver that didn't exist before. So while gold got expensive from safe haven demand, silver stayed cheap despite massive industrial consumption. That disconnect can't last. The supply situation has changed. In previous decades, when the ratio got extreme, silver supply was abundant. Mines ramped up. Inventories were high. Supply could meet demand. Not anymore. Mine production peaked. Inventories are depleting. Above-ground stockpiles have been consumed by years of deficits. When the ratio reverses this time, supply can't respond. That means the move will be larger and faster than previous reversals. Gold is expensive, silver is not. Gold just hit new all-time highs above $2,700. It's priced for central bank buying, geopolitical crisis, and currency concerns. Silver is trading at $50. That's below the 2011 high of $49, and nowhere near the inflation-adjusted 1980 high of $150. Gold has priced in the crisis. Silver hasn't. When silver catches up to where gold is telling you markets should be, the move will be explosive. The mining cost reality? It costs miners roughly $22 to $28 to produce an ounce of silver, including all-in sustaining costs. At $50, margins are healthy but not extreme. Gold costs $1,200 to $1,500 to produce. At $2,700, margins are enormous. When gold is trading at double production cost and silver is barely above double production cost, the ratio is distorted. Eventually, capital flows to the undervalued asset with more upside potential. Central banks buy gold, not silver. Central banks have been buying gold at record rates, over 1,000 tons annually. That demand supports gold prices and keeps them elevated. Central banks don't buy silver for reserves. That demand doesn't exist for silver. So silver lacks the institutional buying that supports gold. But when the ratio is this extreme, private investors step in. They sell expensive gold and buy cheap silver. That rebalancing trade drives the ratio lower. The smart money trade. Professional commodity traders watch the ratio closely. When it exceeds 80, they start swapping gold for silver. Sell 1 ounce of gold at $2,700. Buy 85 ounces of silver. Wait for the ratio to revert to 60. Now your 85 ounces of silver buy 1.4 ounces of gold. You made 40% in gold terms without predicting absolute prices, just by trading the ratio mean reversion. This trade has worked every single time in modern history. and it's setting up again right now. The options market confirms. Silver options are pricing in massive volatility. Call options at $75 and $100 are trading actively despite being far out of the money. This shows sophisticated traders expect large upside moves. They're positioning for silver to make up ground against gold rapidly. When options markets price extreme upside, they're usually right. Not about timing, but about direction and magnitude. The ETF flow divergence. Gold ETFs have seen inflows. Investors buying gold through funds, supporting prices. Silver ETFs have seen outflows. Investors selling or staying away. This is classic capitulation behavior that marks bottoms. When everyone hates silver relative to gold, when flows are negative, when sentiment is terrible, that's when the ratio extremes form. And that's when the setup becomes perfect. Why this reversal will be bigger. Past reversals happened in normal supply environments. This one is happening during a structural supply deficit. Past reversals happened with moderate industrial demand. This one is happening with exploding solar, EV, and electronics demand. Past reversals happened when central banks weren't printing money aggressively. This one is happening with massive monetary expansion globally. All the conditions that drove past reversals exist today. Plus, additional fundamental drivers that didn't exist before. The psychological flip. Right now, investors think gold is safe and silver is risky. That's why gold is expensive and silver is cheap. But when silver starts catching up, psychology flips. Investors realize silver has more upside. They see the industrial demand story. They recognize the supply deficit. Money flows from expensive gold to cheap silver, not because gold is bad, because silver is extremely undervalued. That psychological shift drives the violent ratio collapse, and it always happens faster than people expect. The timeline of past reversals. 1991, ratio peaked at 82, collapsed to 40 within 18 months. Silver doubled against gold. 2008, ratio peaked at 83, collapsed to 31 within 30 months. Silver tripled against gold. 2020, ratio peaked at 120, collapsed to 60 within 12 months. Silver doubled against gold. The moves take 1 to 3 years, not decades, not slow grinds. Explosive moves within relatively short time frames. The $75 target. If the ratio reverts to 60 to 1, with gold at 2,700, silver needs to hit $45. That's just mean reversion. If the ratio overshoots to 50 to 1, like it did in 2011, silver hits $54. If the ratio crashes to 40 to 1 like historical extremes, silver reaches $67. And if silver's industrial demand keeps accelerating while supply stays tight, we could see the ratio drop to 30 to 1. That puts silver at $90. None of this requires gold to rise. Just the ratio normalizing. The amplification effect, here's the powerful part. If gold also rises while the ratio normalizes, silver moves even more. Gold goes to 3,000 and ratio drops to 60. Silver hits $50. That's a 100% move from current levels. Gold goes to 3,500 and ratio drops to 50. Silver hits $70. That's 140% from here. Silver amplifies precious metals moves. It lags on the way up but accelerates explosively once momentum builds. What insiders are doing? Large silver holders are positioned. They accumulated when the ratio was extreme. They know the historical pattern. Retail investors are just starting to notice. Institutional money is beginning to allocate. When momentum traders and technical analysts see the ratio reversal starting, they'll pile in. The last ones in will be the general public who buys near the top. But the early positioning happens now, when the ratio is extreme and everyone thinks silver is dead. The risk-reward setup. The risk? Silver stays range-bound for another year before moving. You wait with capital deployed, but not losing value in real terms if you own physical. The reward? Silver catches up to gold like it always has historically. 50% to 200% upside within 1 to 3 years. Risk-reward at extreme ratios favors silver overwhelmingly. You're betting on a pattern that has worked 3 times out of 3 in modern history.